After the central bank meetings, what is driving stocks specifically now? So I think if we look at US stock indices, obviously the AI market is just blistering stocks higher. Markets started to price a Fed cut in March of 150 basis points, 1.5%. That cut in March has now disappeared, but the market is still pricing in quite a lot of cuts. And this drove stocks higher in January and the beginning of this month. You can see the USA 30, what we call the Dow here. This is a 4-hour chart since January the 1st. That's a strong move higher, but you can see the Fed meeting highlighted here. This is where Powell was actually a little bit more hawkish, but stocks are back testing the highs. It's very difficult to understand here quite what is driving this, but I think they're getting a lift from the earnings reports. We've got some of the big tech names, the Magnificent Seven, if you like. And the payrolls, the reason why I think the Fed was quite hawkish is we had a blockbuster report out of payrolls. You can see this chart on the right. So the economy is actually suggesting it's far more robust than we originally thought it would be after 500 basis points of rate hikes. But the market is now beginning to think, well, if there's a stronger economy, that could be good for earnings. And so that is one of those things that unusually with yields rising, we actually saw stocks rise as well. And that's why, because people started to focus back on better earnings, possibly for 2024. So looking forward from that, I mean, there's some questions arise from there as well. So can US data continue to outperform? At the moment, with the confidence of the consumer so high, that could spill into greater spending into the first part of 2024. And indeed, we are seeing some of that. The housing market is still pretty strong. I think earnings have come in better than expected, although the bar was set fairly low for some. But, you know, this higher stock market, it is being driven by just a few market specialists out there. If we look under the or below the Magnificent Seven, if you like, through the S&P, not all of them are doing quite so well. So if you're in sector specific or single stock specialist, then you need to be careful who you trade with because they're not all doing fine. But the indices are certainly looking pretty strong. I would think the first cut now is priced now for May. With the data still strong, is that still going to be the case by the time we get some more tier one data? So with 80% of the companies so far reporting better than expected earnings, this trend could actually continue if the consumer stays resilient, confident, and spending. So I think there's some key points of data we really need to put on our diaries at the moment. And one of those is the CPI data. That's Tuesday, the 13th of February. Put that as a note. That is going to move the markets, I can assure you, unless it's bang in line and the market goes to sleep. I think there's a very real danger that markets could move on that. The PCE inflation is the Fed's favorite gauge of inflation. That comes out on the 29th of February. That's a Thursday. Put that in your diary as well. And I think non-farm payrolls, obviously the 8th of March, is a biggie as well. And then I think, you know, one thing is worth saying whilst we're looking at stocks is there is historical evidence that February can actually be a bit of a poor month for US stocks. So just bear that in mind as we're going forwards.
Great, thanks for that, Mo. I think it's quite an interesting backdrop on the technical position at the moment. And when we look at the US 30 Wall Street Index on a daily chart, it's difficult to really sort of see too much that is negative within the overall structure. You know, we're still posting higher highs. We're seeing further support developing today to see a recovery materialize. And it is still a bullish trend. It's difficult to stand in the way of this move, but having seen this sort of rally from October into the end of last year, which was a pretty aggressive upside move, there is a distinct slowing in upside momentum. You know, the speed of the upside move now is significantly less than it was during sort of Q4 last year. So is that a concern? I mean, I think, you know, certainly if we start to see something like the indicators turning down, which are threatening to do that at the moment. We've got the daily MACD threatening to cross below its moving average. Although what I would say is that we are still above zero. So this is still reflecting a more positive trend. And we now have momentum, which had hit overextended conditions, turning lower and see a corrective backdrop, even though the market is finding fresh support. However, really, while the MACD is above zero, it's difficult to really view this as a significant negative outlook for stocks at this stage. And really, for me, the important support focus for the Wall Street index is this mid-average, the Bollinger mid-average, which is still rising, reflecting a positive trend. And that stands at 38,155 as we stand at the moment. So for me, that is the important support focus. And while we're above that on a daily closing basis, the risk is that we can still see further attempts to push higher, although seasonals within February are a little bit more cautious, and that could well be a reason behind the slowing in upside momentum. And when we look at the 4-hourly chart, again, we have evidence of the market sort of struggling to really sort of make a significant headway from this type of area. You know, we're trading around the Bollinger mid-average, which is now flattening out. So that's more of a consolidation sideways type signal. We've got the 4-hourly MACD just above zero, threatening to cross below it. And momentum's also threatening to turn down as well. Although until we start to see more negative trending conditions, it's difficult to really sort of view this as anything more corrective. So I think, you know, the concern that I have is that the latest rally into yesterday's high, or any sort of further upside developing from here, is just a weak test of the February upside extreme. And what I mean by that is that the market establishes a high, which was February the 2nd. We then see a sell-off, which we saw into this recent low, and the market attempts to bounce back. However, that fails to impress in terms of commitment of buyers, so it doesn't rally that aggressively. Volume's not particularly that impressive. And we fail below this February 2nd high to see fresh selling pressure developing. So as we stand at the moment, I think the daily chart is still more constructive while we're above that Bollinger mid-average. But we're just starting to see a few concerns slipping in while we're below this February 2nd high that may well start to see pressure beginning to build. And that's certainly something that we need to monitor and watch over coming sessions to really suggest where we're beginning to see more significant sell-offs beginning to materialize. So that's the US market. I'm going to hand back to Mo, who's going to look at the European stock.
Okay, European stock indices, the Eurozone economic data, I have to say, disappoints. Some of it extraordinarily weak, and particularly out of the engine of growth for the EU, Germany. So there's a bit of a conflict here between the markets and the ECB again, because the market is pricing the first cut to come in April, but the ECB is really talking about June or midsummer. And it seems there's a bit of a split at the ECB, but European company earnings have actually disappointed, whereas a lot of the US ones have beaten. So, they're still talking about these earning misses at a 15-year high. And you can see on the chart on the right here, these earnings are still coming in with pretty low expectations and failing. So Eurozone companies look for a bounce in Chinese economy because they are quite closely associated with the strength and relative health of the Chinese economic growth. As you can see here on the Germany 40 chart, since January the 1st, we did take off and the ECB meeting was a bit mixed, but we haven't had the same trajectory since January the 30th that we've had in the US markets. This looks to be like a bit of consolidation near the highs, but less than convincing to me. Obviously, looking forward, the question is, could this weigh on the European indices at current levels? And I think the weakness of the data and the structure of the EU economy rather is very different to that of the US. And so what you can see quite often is geographical rotations from one area to another. And I think at the moment, Europe may be suffering a little bit about recession threats. And there seems to be none of those at the moment in the US. So I think, maybe that's what's been keeping the dollar slightly bid recently. but I do think that the European markets, investors are looking for lower inflation readings to hope that the ECB can start to gradually cut rates. They're hoping for that, but the problem is the ECB was slow to hike rates when inflation was there. It looks like they could be slow to cut rates when they're there. And remember, rates are very restrictive at the moment, which is putting a lot of pressure on the European economy. And that could be dangerous to wait. But at the moment, I think the market wants to see an April cut. They're pricing an April cut. The question is whether the ECB is going to give it to them. So I think what I want to do is have a look at the plus 500 chart of the Germany 40 to see what it shows. And, realistically, this sideways action is a bit of a problem. But Richard, what have you got on this?
Yeah, very much so. I agree with you completely there. I mean, in that, the market is really sort of struggling within the Germany 40 index to make any significant headway from here. We're being held by the December high. And yes, the market's rallied and we're within an uptrend, and the Bollinger mid average is probably still the important support level on a daily basis at 16,896. And while we're above that, we can still look for more positive themes to emerge. However, as you've said, we're really sort of caught within a more choppy sideways trading activity with no real sign of sufficient bullish commitment to really break these highs and start to push towards higher levels and extend what is obviously been a more longer term positive trending condition. So, I mean, I think really what the technicals are suggesting is that while we're above the mid average, we can see further attempts to push higher. But the risk is that we can develop this choppy sideways trading activity below this December 14th high until we see some sort of commitment, be it the bulls or the bears, beginning to gain the upper hand. So really, from a technical perspective at this stage, it's difficult to really see too much developing in terms of significant price movement. And I think it's really a matter of watching the support against the resistance levels that we've discussed, and really waiting for one of them to give way to suggest where the next significant directional bias is beginning to materialize from. So for European stocks, Germany 40 in particular, maybe it's a little bit more of a watching brief for the current time anyway.